We're almost midway through the calendar year, and stocks defied expectations in the first half of 2023, but is there still room to run? Concerns over the Federal Reserve's rate hikes tipping the U.S. into recession have reemerged, however, with equity markets on the lookout for any factor that could influence the central bank's thinking. Goldman Sachs strategist Peter Oppenheimer says the upside in stocks is likely to be constrained as investor optimism over interest rate relief is premature. For more on what to expect in the second half of the year, we're joined by Anna Han, Wells Fargo Securities Equity Strategist, and Jonathan Boyar, the Boyar Value Group President. Guys, thanks so much for being here. Jonathan, I'm going to start with you and the resilience that we have seen in the market thus far, last week's dip notwithstanding. What happens now?
That's a great question. And, I guess you have to take a step back. In the beginning of the year, no one would have ever predicted that the S&P would be where it is now, as well as the QQQ. So it's pretty hard to make these types of predictions. But the one thing I would say is this is a classic example of why you have to stay fully invested, because you never know when the market will go up and will go down. It's better to take kind of a long-term approach. But if history is any guide, if you have a strong first half of the year, the second half of the year is also strong. That's going back to data from 1945, and this really shouldn't be much of a surprise either. If you look back historically, the third year of a presidential cycle is typically quite strong. No strategist going into the year would have expected this, but if you look back at history, it shouldn't have been unexpected.
But I guess the anomaly here is that we have never had a Fed that's been in a rate cycle pattern or rate hiking pattern at this point in the cycle like we've seen right now. And Anna, I guess from your perspective as well, does that mean even if the S&P 500, because to Jonathan's point, we've seen that move higher by about 13% year to date, does that mean that the rally is still on into the second half?
It's possible that the rally still has some legs. And you bring up a great point, Jonathan, that, it's Fed path driven here. But something we keep in mind is what is really leading this market? Where's the concentration? And the lack of breadth is something we've had a lot of conversations on. So even if you say to be exposed to the market, really it becomes what part of the market do we want in our portfolios? And also, how much more can this AI-driven fever go? You look at really, it's been the top 10 names, maybe even 8 names in the S&P 500 that has led this rally. Even if the Fed decides to go another 25 basis points, which is what we expect in July, perhaps even 50 basis points is on the table for the rest of this year. It's very possible that that's not enough to really cool the market unless we really see something break the consumer. And so far, we're not seeing big signs of that in the data.
So putting all that together, and it sounds like you think that we could still see stocks continue to move higher from here.
I think it's possible. At the same time, something that we have noticed is because people are expecting the Fed to cut, though we don't think that it's going to happen that quickly, the expectation of yields probably coming lower in those Fed cuts have helped bring out a little bit of risk appetite. Now, risk appetite has been expressed also in a little bit of a rotation that we've seen into more small cap space. So if we see that rotation gain some momentum, we might see large cap stall out, move sideways. We might see a little bit more life breathe into the small cap, mid cap space. So that's one possibility, and that's what we're looking for.
Do you also think 50 basis points through the end of this year? BIPs? I just love using the word BIPs sometimes.
Yeah, it's a nice word to use. I really can't comment on that. Who knows what the Fed is going to do? What they say and what they do has been very different if you look back over the last year or two. But to Anna's point, I think the best area to be in is in small caps right now. It's by far the cheapest area of the market. If you look back over the past 5 years, the Russell 2000 has basically done nothing, which is, and it's underperformed larger caps by about 7% per year. You look at the S&P 500 equal weight, which has more of the smaller names in there. It's up only about 4% this year. So that's the area where there's opportunity, as opposed to these large cap names that, for the most part, are pretty overextended.
Well, opportunity is all well and good, but something has to change in order for, in other words, that underperformance could continue unless something changes. What would change to catalyze those small caps, for example, Jonathan?
Well, it's valuation, but as to your point, valuations have been cheap for a long time.
Valuation alone isn't usually a catalyst, right?
It's hard to tell what the catalyst will be. No one would have thought there would have been a banking crisis in March, so it's hard to tell. So if the best prediction of future returns is valuation. So if you can just stand the pain and not have the try and go for instant gratification, I think people over the next 5 years will be very happy that they invest in kind of smaller cap names. And I think it pays to be selective because, especially in those areas, not all names are created equal.
And Anna, small caps right now, or do you remain defensive? Where are you kind of overweight or saying that there should be the most focus in an investor's portfolio right now?
Well, we haven't actually been that defensive in our portfolio, at least not in the traditional sense. We came in the year long, media and entertainment. And while we did ask investors to trim the volatility in their portfolios and be conscious of having some low vol exposure, or at least avoiding high vol exposure, we weren't looking to be in the Utes or REITs or staples space. And something that Jonathan mentioned is you have to be selective down the cap. We know it's a riskier play, but something that might change as well, in addition to valuations and traditional fundamentals, look at the technicals of how much the Uber caps, or you can use as a proxy, the Russell Top 50, have outperformed the basic broader market or the S&P 500. When you look at how that's done over a 5-6 year basis, you've seen that it's hitting its technically overbought levels. And that is also another signal to add on to Jonathan's point about valuation, why maybe it's time that small caps can have its chance in the sun here, or at least that we see a little bit of losing steam in this fever of these very concentrated biggest names leading the market.